People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the Black Swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. My name is Randy Cook, and each week Charisse and I sit down here and talk through some of the issues of retirement. We're hopefully hitting on some of the things that you're wondering about and worried about. And if we don't, well, here's what you could do. You can call Charisse and sit down yourself and actually have that retirement meeting to find out what you're in for, what you've done, all those different things. 833-368-3680. Charisse, how are you doing today?
I'm doing great.
Good.
I've been golfing a little bit. My game's getting better.
Mm-hmm.
Want to make sure I can impress Mr. Tim Tebow here.
Uh-oh.
In the future, we'll be golfing again. And I want to make sure my game is like 180% better than last year's game when I played with him. I had the whole day with him, and half the game was decent. The other half was not decent.
Well,
so
that's golf.
I was trying to, I know. You know what? That's just me. Because I never take it that serious. So I'm taking it very serious. I'm actually getting lessons from two different places. So that's exciting. CJ at Golden Ocala and Keith over at the Country Club of Ocala. And what I've learned, I have created my own swing.
Well, everybody does that.
Well, it's my fault because 6 years ago when I really started getting into golf, I did 3 lessons.
Yeah.
One on chipping, one on putting, and one on an iron, just a 7-iron. And that was it. I'm like, oh, I got this figured out. So I am just like people who do not come in and see a financial advisor. I'm like, I got this. And I play scramble, so I never really had to play a real 18-hole course because you're taking the best ball. And so I had to play 18 holes when I did the Waste Management Open Pro-Am recently. And so I was prepping for that, and I've now fallen in love with it. I don't know why. I can't get enough of it. And when I don't get to go hit some balls, I feel guilty. And I know how to swing, something with the face, something with my swing, something with the toe. I'm getting really good. And I am hitting what I hit at. So I just got to say it to everybody. I'm going a little long on this, but I hit my 7-iron to hit that 100-yard shot at the Waste Management Open on hole 16. You got to get it on the green or you get booed.
Or you get booed.
I'm now hitting my 9 100 yards.
There you go.
I know. I am so excited.
That's
no
big stuff. Very
it's
nice.
Huge.
Very
all my clubs
nice.
are like going so much further. I'm like, because the swing is right. Because I got some coaching.
See?
I paid a little bit of money to get better. Hey, retirement planning 101.
I say to everyone, Tiger Woods, greatest golfer of all time, had a swing coach. James Earl Jones, the voice of Darth Vader, the voice of CNN, had a vocal coach. There's no reason why you can't have a retirement coach, okay?
Yeah. And speaking of Tiger Woods, I got to hang out with him last year on the golf course and play some good old golf. And I asked him what was the key to golfing. He says, play. Play for real, not just in a simulator, just not in your backyard on a driving range. Get out on the grass and play. And that's what he said. I went, oh.
There you go. From Tiger Woods to your ears. There it is.
Yep.
All right. Well, welcome to Retirement Coffee Talk. This isn't a golf show. This is a show about your retirement. But,
Depends on the day.
When you're in retirement, you probably will do a little bit of golf here and there. And the main thing is to get the finances in order so that this 20, 25, 30 years of unemployment is not going to feel like that because you've got the money you need to do the stuff you need to do. So as you go into it, what's your attitude about that money? A survey from Global Atlantic Financial said they talked to people between the ages of 55 and 75, people getting ready for retirement and people in retirement, and found that over half, 60% of people said, I want you to protect my money, Charisse. I am more interested in that than I am growing my wealth. Is that the attitude that you see overall when people sit down with you?
I see, honestly, a 50-50.
Okay.
I have people who come in and say, I don't want to lose a dime. Sharice, if I give you $1 million, if you lose a dime and you charge me a fee,
You're fired.
It's so funny. I'm fired. So those are the ultra conservative people. So I have those people, and I have the realistic people that says, I could take a loss at 10 or 15% to be able to get the market growth I want. And then I have the other people who are just over risky. I just sat with somebody, and $2 million in the S&P 500 and no backup plan is insanity to me.
Wow.
And sometimes it doesn't matter how you keep things so simple for the person, they still don't get it. And they will get it the day that they need their money and the market's gone down and they lost half. And now you're just in this double whammy of a hazard because now you can't catch up. So we want to be really careful when it comes to windows of opportunity, whether they're good or bad. The bad ones hurt us. The good ones really help us. And so there's a lot of windows of opportunity, Randy. And
well, how do you find the balance? How do you, because you've just described to me people of all range of risk levels, people who don't want to lose a dime and people who want to go at retirement like a riverboat gambler. Okay.
Right.
How do you talk to people and say, those of you who are in this conservative area, that's fine, but we do need some growth, and where are we going to get it? And to that person who wants to be way out there on the risk scale, you say, we have to have some kind of protection. How do we go about it? How do you do that?
Yeah. So we have to have the income conversation, the safety conversation, and the growth conversation. And so I literally just had somebody come in and say, Sharice, okay, we're doing really great, but I just want to make sure we're extra conservative, but still have money in the market. And do you think we can pull some money off the table and put it in something other than a CD, a money market, or annuity? I said, sure. I said, we have a great income fund that is managed every month. And literally, this was this week, it was up 11% over the last 12 months. And she's like, how does an income fund that has a very small standard deviation, which means it's not very volatile and it's very conservative, it could lose maybe 5-7%. That's perfect. That's where we want to be and make that kind of money. I was like, because it's actively managed. And as things are changing with interest rates, we're going to buy and sell certain fixed income bond funds, cash equivalents to make that portfolio work to its best. So we took advantage of the opportunity. So this was a window of opportunity that we took as advisors to take advantage. So we took less risk and we had a higher rate of return. Crazy, right?
Gotcha.
If you had a 60-40 portfolio, I'm not sure you made that much, right? Ours did because it's actively managed every month. So taking those opportunities. There's other opportunities right now where the fixed rate environment, this 5-year fixed rate, I saw it like 5.2% is fantastic. Take advantage of those fixed rates. There's other indexing strategies you can get into where there's no fees, right? No losses. You still can invest in the S&P 500. And, if the S&P goes up 10, you can make 10. If it goes up 20, you might only make 10, but you don't have to worry about the losses. So windows of opportunity, things are really good still now and really juicy. And markets are at its peak. So, how much money do you want to make in retirement? I tell people, you saved $1 million, don't screw it up. Why, why do we have to take incredible risk? You've been taking risk your whole life, right? Job to job, business to business, families to families. Risk tolerance was super high and you could take so much risk when you were getting a paycheck. Now you're not getting a paycheck. Don't mess it up because this is how people run out of money. So that's that part. But then there's also windows of opportunity for taxes, Randy. I mean, we always talk about income and investments, but there are an absolute windows of opportunity for taxes. And there's not enough people across the country taking advantage of it. We do tax planning. I am so proud of it. I have amazing tax planning software. There are not enough people taking advantage of coming in to see us to get a free consultation on their taxes. No, I'm not going to do your taxes. I'm not going to do your accounting. No, I'm not going to do your bookwork. If you want to do a long form, you got to do it. Go to my CPA. We'll send you to our CPAs to do that. But one thing that the CPAs won't do that we will do is we'll build that tax plan for you now, for if you pass away, and to your heirs, your legacy. Who's getting that money? Do you want it tax-free to them or you want it all taxable, right? Because taxes are really kind to us right now. And some other windows of opportunity is rolling some of our IRAs over to a Roth, Randy. We talked about that, right? Because there's different times to do that. Should you roll IRAs and 401ks to a Roth while you're working with your employer and you're under 65? Probably not depending on your income, because if your income's super high, it's probably better to wait till we don't have an income. I'm not going to tell you yes or no over radio. That's what us advisors are trained to show you through our software and planning for you. Do we wait till we're 60, 62? Do we collect Social Security and roll IRAs over to a Roth IRA? I'm not going to say yes or no. Some people do, some people don't. It just depends how much income's coming in. So I had a young lady who's like, Sharice, I have 7 years of income in cash making 3 or 4%. I can live off that where I roll my $1.5 million over to my Roth IRA because she knows she can pay the taxes on it. She knows she can still survive on her income, and she's going to wait to take Social Security to age 70. Longevity in her family is like 95. So it all made sense, but that doesn't make sense for every household. So it's not cookie cutter. So taking advantage of those windows of opportunity. And the other window of opportunity is Donald Trump has given you, if you're over 65 and older and you're collecting Social Security, $6,000 for each person, as long as your income, if you're married filing jointly, isn't over $150,000. So if your income is at $100,000 and you're married filing jointly and you're both taking Social Security, you can get an extra $12,000 to write off. And if you're thinking, oh, Sharice, the window of opportunity you're talking about, here we go. I could roll IRAs over to my Roth IRA, use that $12,000 in credits that you're getting from the government before it phases out in 2028, and then not pay taxes on that rollover, technically, in a nutshell, depending on where your taxes are. So yes, use those windows of opportunity. Yes, Social Security might be tax-free in the future, but don't count on it. If it happens, it happens, right? So these windows of opportunity are the things that your advisor should be sharing with you, showing you in a tax plan, showing you in an income plan, showing you in your investment plan. So if you got 5 pillars in retirement, which is 1, your investment plan, number 2 is your income plan, number 3 is your tax plan, number 4 is your healthcare plan, and number 5 is your legacy plan, all these have to be covered, because that advisor who focuses just on the investment plan is going to charge you 1 to 2%. So why would you just work with an advisor that's going to charge you 1% to give you stocks and bonds when you can work with an advisor that gives you all 5 of them for the same fee?
Good point.
Right? That's the retirement plan.
That's what we talk about here on the show all the time. When it comes time to find that person to help you with retirement, what specialty area is that person in? If you had a stockbroker, or as Sharice calls a stock jock your whole life, which is great. You've had somebody helping you grow your money. And now you get to this point and you say, hey, I'm supposed to file for Medicare at 65. What do I do? You think that stockbroker is going to be able to help you with that? No, because that's not their area of expertise. That's where Sharice has kind of planted her flag. And that's where she helps people, is move into that area when it's going to come time to spend your money in retirement. Give her a call. Let's talk about how that works. It's 833-368-3680. 833-368-3680, or use the website, which is zinniawealth.com, ZINNIA wealth.com. There's a button there that says Complimentary Retirement Consultation. Click on that. You put a little information in there, and the team will reach out to you and sit down and say, hey, what's got you bugged? What's got you concerned? What's got you scared? Let's get it all out on the table and build a plan for it. Again, 833-368-3680. All right, so if you ask people in retirement, what is your biggest regret? Many times they'll say, I worked too long. I like retirement, and I should have retired a little bit early. So a lot of people, will say, I wonder if I can retire early, and some people do. And this is a guy who wrote into MSN, into the advisor column there, and he says he retired at 62. He filed for Social Security at 62. And then he found the wrinkle, and that is he's got to get from 62 to 65 to get to Medicare, so he's going to have to fund his health care himself. And he said, holy cow, was that expensive? And he had to go out and get a part-time job in order to get that money. Well, then when he had the part-time job, because he retired early, that income went onto his Social Security statement, and his Social Security got cut back. So he's in this vicious cycle, this vicious circle. So, Sharice, this is something that people might not understand or know about if they decide to retire a little bit early. But this is something we talk about regularly. There's a bit of a list of things to watch out for, isn't there?
My question is, before he went back to work, did he actually sit with a financial advisor, and the financial advisor said, I had to go back to work? So he might have messed himself up. This was a hazard that he made a mistake on. He He probably didn't even have to go back to work, but because he didn't have a written plan or an income plan, he didn't think he needed a financial advisor. He killed himself for the next 3 years.
3 years.
And then messed up everything else, right?
Yeah.
Domino effect.
Yep.
Taking opportunity to sit with an advisor to get a second opinion. Because what I find out, most people, when they retire early, they can retire early.
Mm-hmm.
Some people just do it on their own merit, thinking, yeah, I can do it. Why not? But they don't really know, but they go for it. So I'd be curious about that.
Well, the healthcare thing, though, that is probably the biggest deal, isn't it? What are you seeing out there? Because, I mean, you do Cobra, that's 18 months. That wouldn't help him. And that's like, gosh, it's like almost $2,000 a month. So you go on to Obamacare and you do that. And what are you seeing out there that the cost that people have to deal with here?
So, if you're working with us, we're talking about the subsidy program.
Mm-hmm.
You can get a great health insurance plan. And if you don't go back to work and you collect Social Security, you might be within the threshold to pay like hardly pittance on your health care.
Okay.
So why go back to work for health insurance if you can qualify for the low subsidy with the Obamacare plan, right?
Mm-hmm.
A lot of people do that. I know some of your listeners like, yes, Sharice, we have beat the system. We are doing that. We can't roll IRAs over to a Roth right now because of that, but we will here in a couple of years. So there's always this, I call it the eggshell moment, where we're walking on eggshells.
Yeah.
And you either work with an advisor that's going to help you figure that out and figure out how to qualify for the low subsidy. But I mean, honestly, if there's 2 Social Security checks and there's 2 pensions, it's probably not going to happen, right? It depends on a lot of moving parts and the math. And so, yeah, a lot of people pay a lot of money. A lot of people will pay for Cobra for 18 months. I'll pay $1,400 to $1,800 a month. And then they come off and then they're looking for insurance plan. So we are having you sit down with our associates that do the under 65 healthcare with the Obama plan, with regular plans. We're going to consult you as well. Like, should you do Cobra? And, here are the factors based on your health. Maybe you got some major health issues. That could be a reason to stay on Cobra because that could cost you a whole lot more money unless you do qualify for one of the subsidy programs. So when it comes to healthcare, that's my 4th pillar of the retirement puzzle. We want to make sure we dial into the healthcare, get the right plan. Some of you are leaving your employers and you can keep that insurance forever. You can come over to the private world. But a lot of people probably shouldn't stay with the employers because it's so expensive. So it depends on what the employer is offering you, right? And what the copays and deductibles are. So we want to do the math to that 4th pillar of your healthcare plan, which also includes long-term care planning and the future of that. And do we need a plan for that? So don't be that person that says, I'm going to retire. Realize as you collect your Social Security check that you also need health care because it's going to cost a lot of money, and then go back to work. Before you go back to work, come see us. I've seen this 1,000 times, and a lot of times we can keep you retired. Let's do the math. Let's see what it looks like. Let's see what you save. Let's take inventory. Let's look at your liabilities. Let's make sure inflation is covered every year. And let's work out a plan that makes you feel solvent so that you don't feel like you're going to run out of money.
Yeah, that's the thing that this guy said was this whole 3-year period of time cost him so much money. He felt like he did huge amount of damage to his retirement nest egg just digging his way out of this. And if he had it to do over again, he probably would wait a little while. For some people, that decision is made for them. And people will come to you, and we're seeing all these layoffs right now, thousands of people in some of these big companies. And if you're 62 years old and you thought you were going to go to 65 and all of a sudden you've got no health care and you've been laid off, then you got to make a decision whether or not you're going to go back to work again. And if you go back to work again, what can you get at age 62?
That's no fun.
No, it isn't.
And that's no fun.
Yeah.
Can you imagine retiring and all of a sudden like, oh, I got to go back to work.
I got to go interview again. And now you're in that world of, putting your resume out there and there's 500 people that are applying for the same job and you don't have the right verbiage because the last resume you wrote was 30 years ago. And it's a whole different world now trying to find a job, isn't it? I mean, it's very, very different. I heard somebody...
It's harder to get a job.
Yeah. I heard somebody say, should I just put on the orange apron and go to work for Home Depot for a couple of years? And maybe that is the answer. Or Starbucks, you put on the green apron and they've got,
That's a tough job. You ever seen those lines?
They work hard,
I wouldn't want to work at Starbucks.
Yeah,
Actually, I do want to learn all that stuff. But man, they get busy. You don't want to work there.
I don't think so either. I don't think I have the energy for that. But
you deserve an easier job.
Yeah. But I mean, that is the thing, though, do you go back to work part-time and try to make yourself get to that? I've met so many people that have said, I'm only working to get to Medicare. I've heard that over and over again. And they're basically quietly quitting, as the new phrase is, you know?
And you know what, Randy, is those people, they don't have to keep working to get to Medicare. I have done the math over and over and over again. I'm going to tell you, 9 out of 10 people that we have done this with, it made sense. Go ahead and retire. People just think insurance is so expensive because it does sound expensive. You're like $1,000 a month, $800 a month, subsidy, maybe $100 a month, $200 a month, maybe $1,400 a month for the next 3 years if you retire at 62. And so when we put the math in, it's just a small piece that if you saved enough, that when we do the math, it doesn't even put a dent in the plan. Yeah. I've done it over and over again. I was actually shocked when we started putting those health insurance plans together and figuring out the math on their income. And I went, wow, more people can retire. They do not have to wait. I mean, we retired people at 55, 60, you know, 65. Yeah, some people work till 70 because they just love what they do. But we don't want to work that long because, you know, life is, you just never know what's going to happen next.
You bring up a really good point, though, because sometimes when I do stories about, you know, your Social Security being taxed or your Medicare premium going up for a year, if you start to look at that in totality and say, I was supposed to pay $220 a month, I'm going to pay $300, that's an extra $80 a month. Through the year, that's this much. I guess that doesn't put that much of a big dent in my nest egg. And so you got to kind of look at it that way. Everybody's worried about inflation. And they say, you know, going out to eat went up 5%. Well, that sucks. But if you look at that for an entire year, how much is that? It might not be as much as what you think. And a lot of people blow some of these big things out of proportion, don't they?
They do. Listen, if you have a retirement planner and financial advisory firm that understands retirement, they're going to walk you through income. They're going to show you an inflation-protected income plan growing every year for the next 3 years because your dollars today is not what you're going to get in, you know, the next 5 to 10 years. Your purchasing power changes. We need to cover your purchasing power because if you don't know what future purchasing power you need, that's going to actually hurt your long-term investments and maybe the way that you live in your lifestyle. Like, you got to have that in the plan. How else do you have confidence moving forward if you don't have that buttoned up? So we just want to make sure that Social Security decisions are buttoned up. We're helping you make those decisions. Your income, where it's coming from, when it's coming from. Is it the tax-free bucket, the taxable bucket, the tax-deferred bucket? Because there's a timing for all this. And we don't expect you all to actually understand the best strategy. And this is why we get paid to do what we do, is because we do, and we do it every day. And we want to help you all because the sooner we can help you, in my opinion, the sooner you might have a joyful retirement, especially if you're stressed out about it and you lay awake at night thinking about it. We don't want that. We don't want you pacing up and down the hallways just saying, oh, the market's getting rocky. What do I do? Do I go to cash? Do I buy more? Do I take my cash, buy more? Yeah, that's a lot of decision making in retirement. So let us help you with that part of life.
We say it all the time. Do the math on your retirement. If you want to retire early, you're curious whether or not you could retire early, or something happens and you were going to go another 2 years and then your employer had other ideas. Come on in. Let's see what the math says on your retirement. That's what we do here on this show. Give Sharice a call. Here's the number, 833-368-3680, 833-368-3680, or the website is zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that. You'll be on your way. Sharice, that is all the time we have on the show for today. I'll give you the last word.
Well, thank you for tuning in. Don't forget to go to our podcast locations, whether it's Apple phones or Spotify, iTunes, YouTube. We are now live on YouTube, meaning we are doing video podcasting on YouTube. So if you want to see us, you want to see what Randy looks like finally. I know a lot of people are like, what does Randy look like? Hey, we are on YouTube and you can watch our shows there. And as usual, live by design and not by default. We appreciate you so much. And we'll see you next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.